Yeah, so we will go to this class of balance sheet. Just 1 hour I will take. I'll finish the class 1 hour or 45 minutes. I'll tell you how to solve the problems when in the exam it comes. Okay, but as a faculty or as a teacher, I always feel that you must understand the concept of balance sheet. So that's the reason I'll take little bit time in the starting, so that whatever question comes in the exam, even you could able to identify what is the current asset, what is the current liability, and all. So I'll take some conceptual balance sheet today. Okay. So before going to the session, I would like to tell you one important point here. Uh, Whenever we generally in MSME, basically we give three type of loans. One is term loan, another is working capital, and the third one is non-fund based limits. Okay. So non-fund based limits generally only 5% of the branches will do, or 2% branches will do. So generally MSME means term loan and working capital we have to consider. Okay. So first of all, we must understand what is a term loan and what is a working capital. Working capital term loan means it's a creation of assets, like fixed assets. We will give the term loan. Okay, like a businessman wants to put a manufacturing unit, so he want land and building, plant and machinery. Yes, you have to give term loan because it's a fixed asset. For example, computer purchase, fixed asset, term loan. So try to understand this concept of term loan first. So term loan will be always minimum repayment period will be more than 1 year. That is the basic concept of term loan. Okay. So that is with regard to term loan for purchase of fixed asset. Fixed assets mean plant and machinery will come in MSME, land and building will come, even auto, car in services also. We all these loans we will sanction under term loan. Second one is working capital limits. Someone will say working capital, someone will say OD, someone will OCC. Little technical difference is there, but almost all these loans are running limits. Bank, OCC, OD, all these loans are running limits. These running limits are given to the borrowers for for example, for running a shop. Stock is required. For purchase of that stock only, we can give this OCC. So raw materials. In a manufacturing, raw material will be there. Raw material will be processed and work in progress will be there. Finished goods, all three stages will be there in manufacturing. In all these three, your working capital loan amount can be there. Or for example, trader doesn't keep any finished stock, he will bring and sell. So only stocks. So stocks for a trader and a manufacturing unit means raw material, work in progress, and finished goods. For these purposes, whatever loans generally we give in our banks, we call it as OCC, working capital, OD, whatever it may be. I hope you understood what is the basic difference between term loan and working capital. Okay, working capital is nothing but OCC in the second slide. Okay. And one important point I would like to tell you here, never ever give loans for purchase of stocks, never ever give a term loan, and never give a OCC for purchase of fixed assets. This is wrong. If anyone sanctions like that, generally why anybody will sanction also, I will tell you, because you must understand the basics. Tomorrow you will become an officer. You must have an idea why even your manager says you should convince your manager that we should do like this only. I'll tell you why a customer or why a branch manager generally wants to sanction a term loan for purchase of stocks. Two reasons. If you stocks means generally if we are giving OCC, every month we have to take a stock statement and we have to inspect the unit. At the same time, DP every month we have to update the drawing power. Okay, and every year manager and officer has to renew the limits. So it's a little bit process is there, time is required. That's the reason generally we see many expired limits. Okay, so when it gives, for example, if you give a term loan for purchase of stock, these problems will not be there. You need not have renewal after 1 year. You need not go for stock inspection. You need not go for any DP. You need not update any DP in the system. So to avoid these things for easy finance, generally few managers will try to sanction term loan for purchase of stock. Please remember, this is not a good practice or a wrong practice, I can tell you. Okay, if you give like that, tomorrow in inspection, if any inspector comments, it is very difficult to convert that from term loan to working capital. I hope I am clear. But why customer is taking? Okay, manager, I told you some advantage. Why customer is wants a term loan? I will tell you that also. For him also same. Every year he has to prepare balance sheet. For that he has to pay to auditor. Every month he has to take a stock statement. He want to avoid that. Okay, not but and, one more thing is, if it is a term loan, EMI general, not I should not say EMI and MSME loans, but anyway, principal and interest will be paid every month. The liability will come down. After 2 years or 3 years, the liability will come down. Whereas in working capital, the liability will never come down. The limit will always increase. First time borrower will take 5 lakhs for stock. Business will grow 10 lakhs, 50 lakhs, 1 crore. I think by the time of 30 years, if a businessman is with you, the initial stage he might have taken 5 lakhs. Now he might have enjoying 1 crore limit from you. So some customers always think that my liability should go down. For example, 10 lakhs working capital means I have taken means it should go down to 2 lakhs, 3 lakhs like that. Every month I will pay, sir. Then the only option available, then that's the reason always he asks for a term loan. So manager and customer, when both are little bit comfortable, they may go for term loan instead of working capital. So what my request is, being a officer working in advances, you must know these basic differences. Somebody says in the branch means blindly we should not go. That is the reason we should have awareness. We should have knowledge about MSME. Okay. Otherwise, in inspector, if anything is written, then unnecessary we will be in landing in trouble. I hope what I want to tell you is, first of all, basically you should understand what is a term loan and for what purpose we are giving a term loan. What is a working capital? Why we are giving for stocks, and why? And one more thing I told, why we should not give a term loan for stocks, why we should not give a working capital or for fixed asset. This process is wrong. I hope you understood. So ultimately, what I want to tell you here is basically term loan for fixed assets, working capital is OCC for stocks. Okay, this is the basic concept. Always you should remember, and what you should be avoid also you should know. Now coming to the part of book debts. See, you have given a OCC for purchase of stocks. In the godown, if stocks is available, okay. For example, that businessman, for example, I'll tell you, there is a, I will tell you some shop like uh, some shop with regard to manufacturing only I can tell. One bottle manufacturing unit is there, for example. You have given a OCC. The amount was kept in raw material and finished goods. But the stock, if at all this businessman sells on credit. Credit means udar mein diya. Aru. Somebody will pay after 2 months, 3 months means it's called as a credit. Cash, generally businessman will do cash, but in some businesses they should increase the sales for getting more profit, so they will give on credit. Okay sir, you take the stock, payment can be given after 2 3 months. If that person, if anybody is purchasing from your borrower, that person is called as, or person whatever stock he has given on credit is called as book debts. There are three type of names technically we call: book debts, same name; receivables we call; and bills receivable. Okay, all are one and the same. Ultimately, your businessman is supposed to receive the money from that customer, which the stock was given on credit. I hope you understood what is a book debt. That means whatever loan amount you are giving under working capital, mostly it will be in stocks. And sometimes, if in the business premises, if stock is not available, your customer may tell you, I have given on credit, this is a book debt. Okay, this is the concept of stock and book debts. If you understand the basics of these two items, then you will understand working capital more. Why I'm telling working capital is, see, in MSME we give three type of loans. One is manufacturing, another is service, and third one is trader. I believe after my experience in the banking, 95% of loans in the branches will come for the businessman. Whoever comes to us are traders, and traders always required working capital only, because stock will be there. Shops, na? In the market, if you go, all stops only: TV shop, that shop, this shop, so electronic shop, all are coming under stocks. So all are supposed to take OCC. This is the concept. Okay. Now, before understanding the balance sheet, so let us understand. See, for example, if anyone has given a proposal, tomorrow you have become an officer, some proposal has came to you. I told you, for example, first of all, we'll try to understand this particular balance sheet is, if we are preparing this balance sheet, think that now you are a businessman. Okay, you are a businessman, like that I'll tell in the class. For example, you want to start a manufacturing unit. You will approach to a banker. How you will approach, how branch manager deals with you, I'll tell you, so that you will understand better. The first one is, for a manufacturing unit, always it requires land and building, plant and machinery, and stock. Land and building is for security purpose. Plant and machinery is for processing the goods. and remaining these two are fixed assets, right? Plant and machinery. But these are all raw material. See, raw material. Actually, if you take a water bottle manufacturing unit, so the first is a raw material. Then raw material will be kept in the plant and machinery. Then it will process. Then finished goods will be coming out. Okay. This whatever OCC amount will go, it will go to here. Whatever term loan you are giving, it will go to here. I hope you understood. Okay. So manufacturing means they will come for land and building. Sometimes if there is a own land and building, they will come for only plant and machinery. Okay. Plant and machinery. Then they will ask for this we have to give term loan. For this we have to give OCC. I hope you understood how a businessman approaches to a branch manager, and we should have an idea. Land and building, he may ask, plant and machinery, and also working capital for these items. Okay. Now let us see how a person, a businessman, for example, we are starting a business. You want a land and building also in the loan. So land and building, how you will decide? You will go to a civil engineer and you will take a estimation. You will take a estimation. Based on that, you will decide this much amount is required. For example, some 10 lakhs, 20 lakhs, 40 lakhs you require for land and building. Plant and machinery, we take quotation from the vendor who is selling that particular plant and machinery. These two, it will give an idea how much it cost. Margin you reduce, remaining you can give the loan. After analyzing that, whether you want to give loan to the borrower, you can reduce this 25% or whatever margin bank says as per guidelines, reduce, and remaining amount you can give under term loan. Now coming to working capital. Generally, one more thing, whenever we are giving for manufacturing units, generally this OCC, we should not release till the land and building construction is over, plant and machinery is erected. Once everything is over, then only we have to release for working capital. See, for construction, 1 year has taken, for example, 6 months, 9 months for construction, 3 months for plant and machinery. We have given repayment holiday. 1 year we have given. Can you give OCC on 6th month? What is the logic behind that? He has not completed land and building. He has not plant and machinery not erected. Then you cannot give this. Generally, you should not give OCC. That means you should not release working capital limits to the party till you come to a conclusion, you and your manager, that land and building part is over, plant and machinery is ready. Then only you can release. I hope you understand why I'm telling the concept is sometimes branch people, they will release the working capital limits by the time even plant and machinery was not received by the customer or borrower in the unit. Then it will come as a deviation. So inspection, this type of problems are arising. So you should be very careful when you are handling this type of proposals. Okay. So how to handle, just I told you. Okay. So land and building, plant and machinery is over, and working capital also I told you. So this is the amount we require. We want to start a manufacturing unit. So land and building, plant and machinery. We want to start a bottle manufacturing unit, like that example I told you. So okay. Now finalizing. So somebody has quotation we have brought from land and building. We thought 40 lakhs will be sufficient. Then we have taken plant and machinery quotation. We want 40 lakhs. That means this 80 lakhs we require for these two purposes. Then raw material, all these things also we have come to an end. How much we require to run this business, this project, or this particular perform how much is required, businessman has to do. But generally on behalf of businessman, chartered accountant and accountant will do all these things. Okay. So now you see how much it became, 80 lakhs. For working capital, I require 120 lakhs. That means the total for this particular project, I require 200 lakhs. That is 80 lakhs term loan bank can give after deducting margin, and 120 by reducing margin, whatever bank says we have to give. Okay. Now project is over. That means we require 200 lakhs. Then what we will do? Then with this project, we will go to a branch manager and say, see, this is the amount we require, sir. Please sanction the loan. So we will approach the branch manager and ask for his financial assistance. Then manager generally says margin is 25%. That means out of 200 lakhs, you bring 50 lakhs customer, remaining 150 lakhs, my bank will sanction. Here, I would like to stress upon something. See, margin will not be permanently 25% in all the cases. I will quote an example. Generally, whenever you are giving a MSME loans, it is 25% margin. But same MSME loan, if you are giving under Mudra, margin is 15%. Same MSME loan, you are giving under PMEGP, margin is 5%. Try to understand. Margin reduced means customer need not bring more amount as capital. He will, the amount, what he has to bring into the business will come down. Hope you understood. So straight away, no manager should say it is 25%. You should know on what scheme, what product you have selected for this customer. Based on that, margin will be decided. But generally, a banker says OCC means 25%. Stock means 25%. If there is a booked business, we say 40%. Actually, it is not 100% correct. Based on the products, each margin will vary. I hope generally as a branch manager, your mudra loans you are giving up to 10 lakhs. 10 lakhs margin is only 15%, not 25% then. Okay, but book debt it is more 30%. Okay, this is what you should know the concept of margin, and based on that, whatever project comes to you, you have to deduct the margin. Okay, I hope you understood what is now you have approached the branch manager. Now 200 lakhs, but generally that manager told 25% margin. That means out of 250 lakhs, borrower has to bring, and remaining 75%, it is nothing but 150 lakhs we will sanction to the customer. Then see how we will assign. Same, this is what we have projected 80 lakhs for London building and plant and machinery and 120 lakhs for stock, right? Now, what manager told 25% margin is required. So, total is 200. 200 ka 25% is 50 lakhs. This is the 50 lakhs. How the 50 lakhs will be calculated? Out of 80 lakhs, 20%, 25%. What is the amount? It is 20 lakhs. That means out of 80, 20 lakhs for fixed assets. These fixed assets, customer will bring the money. Remaining 60 lakhs, bank will finance. Now 120 lakhs OCC customer has asked. 25% of 120 is 30 lakhs. That means remaining 90 lakhs bank will finance. So it will become 150 and a customer will bring 50 lakhs. So generally once this project has come 120 lakhs, we should ask the customer 25% I told that is coming to 50 lakhs. Please bring your margin, or please I will visit your unit and I will ensure that this much amount you have already invested. Otherwise, we will give 100% finance. 150 rupees if we give 150 rupees stock means there is no margin in the business. Okay. This is what with regard to margin. This money always manager should ask the borrower 25%. Okay. Now let us see in a balance sheet how it comes. Now you see. Same thing. Fixed assets 80 lakhs. I have shown here 80 lakhs only. No difference. London already you know 40. This is 120. Now what happened? You asked the borrower to bring 25%. Okay. So what same thing, whatever I told. See 50 lakhs he brought margin because 80 plus 120 is 200. 25% you told 50 lakhs. The margin, whatever your customer is bringing to the business for 200 lakhs, 50 lakhs, that margin is called as capital. That is the capital in balance sheet, right? But for fixed assets, he brought 25%. This is also margin. And 120 also 25%, 30%. Both fixed asset margin and current assets margin, it is 50 total. Okay. But actually, businessman can show like this also. But balance sheet always it shows both fixed assets, whatever required margin, and whatever required margin for working capital, both will be taken care, and 25% of that will come into the business. That is 50 lakhs. That means what I would like to tell you is in a balance sheet, you will not find 20 lakhs, 30 lakhs. You will find only 50 lakhs. But what is 50 lakhs? Because you brought the margin now in this business, we know 20 lakhs for this and 30 lakhs. But that is not available in the balance sheet. That's why we should know what is the margin we brought for current assets and what is the margin we brought for fixed assets. Okay, that is the latter part we will take care. Now, ultimately, 50 lakhs capital he brought. So naturally, when 20 lakhs is remaining amount, 50 lakhs is over means remaining 60 will come to term loan and bank will finance remaining 90 lakhs to the purchase of stock. But here I would like to tell you one more important point. Generally, party require 120 lakhs, for example, but party this for purchasing this stock, raw materials and all. For example, party says, sir, some businessman is there. He want to give me raw material of 10 lakhs on credit. Somebody is telling, sir, I will give you 10 lakhs raw material. You take it from me. Okay. That raw material, if somebody is giving on credit to this your borrower, he is called as creditor. Then what bank will do is out of 120, 30 he brought. Now 90 is required actually, but 10 lakhs somebody is providing in the form of credit. So remaining 80 lakhs only bank will provide OCC. So this person is called as creditor. If this person is giving this once his stock is purchased, when he is giving all credit, your business, you are giving a credit, that person is called as debtor. That is the basic difference between debtor and creditor. Creditor is providing credit to your customer or a businessman. Debtor means your businessman is providing credit to some customer for selling the stocks. Okay, this is the basic difference, debtor and creditor. Now you see this, how much already we have decided this 80 lakhs in the starting slide, 80 lakhs and 120. Here you are comfortable now. So total 200 lakhs. Now bank asked a 25% margin. You brought 50 lakhs. Remaining 80 minus 20, remaining 60 came from term loan. And actually you are supposed to get 90 lakhs because 90 minus 30, 90 plus, sorry, 90 plus 30, 120 you should get actually. But somebody is giving credit to your customer, you have decreased your bank OCC to 80 lakhs. Okay. So this 30 lakhs plus this 90, all this will become 120 and it will take in care for purchase of stocks. So now the balance sheet is tallied, 200 he wants. Again, I'm repeating, total 200 project we have placed. Manager told 25% margin. We brought 50 lakhs. Remaining bank has given in the form of term loan 60 lakhs to purchase this. And the remaining 90 lakhs bank want to finance, but creditor is giving 10 lakhs. We have reduced our working capital to 80 lakhs. This is for purchase of this. Okay. This is how the balance sheet, and total 200 lakhs you want, 200 is tallied. How it is tallied? 50 lakhs margin, 60 lakhs term loan bank is giving, 110 plus 90 lakhs for from current liability it has come. This is how the balance sheet is prepared. Now the balance sheet is prepared means only one thing manager has to see. As a manager, now what I have to see is everything is okay. If this is correct, content is correct, quotation is correct, everything I will see. Margin I will ensure. Then I will sanction. Then I will release first a term loan for purchase of this. Once everything is over, finally I will do the visits every month or bi-monthly. Whatever amount I am disbursing, whether construction is happening, plant and is came, whether it is installed, everything will ensure. Once this term loan part is completed, project is completed, then I will release this working capital limits to the borrower. Okay. Now balance sheet is tallied. Preparation is almost over. Now you should know what are the technical names which bankers were calling. Okay. Now let us see what are the names. First of all, we will see what is the source and what is the use. Okay. Source and what is the use. As I told you, whatever customer is first purchasing, we told now 81. These are all the assets, right? If bank gives a loan, you will purchase all these assets and you will do the business. For purchasing these assets, what you have done, you have gone to a bank where manager asked you to bring some capital, it's your own money. Then bank has given some loans, right? These are all called as liabilities. These assets are in the business. For acquiring these assets, we have taken some loans. That is, loans are liabilities, one and the same. One is your own margin, your own money. But one day business has to repay your margin also. That's why it's a liability. Capital is also a liability to a business firm. One day capital has to given back. But last resource capital will be given because first we have to clear bank loans. Okay, these three are liabilities. I hope you are understood. These are the assets you are creating. For that you have taken some loans. That is called liabilities. So one more word also they will use for liabilities and asset. Okay. Now first one is asset is called the use. See, using the money and creating the asset. So uses. Assets are also called as uses. One word is over. Liabilities is source. You are getting source from somebody. Capital is your own source. Term loan bank has given, it's a source for purchasing. And one more is stock purchasing also. You have taken some loans, OCC and all are liabilities. Sources, brought the sources, created the assets. So uses and assets are one and the same. Sources and liabilities are one and the same. Because sometimes, last time I think this question only has come. He has not used a word called assets and liabilities in balance sheet. He has used short-term, long-term sources like that. Then if you don't understand the concept of source and use, you may get confused. Okay. Now I hope you understood what is the source and what is the simply asset is called as use. Using the money and creating asset. So uses. Liability means source. We brought some money from outside. Own capital, term loan, even your bank OCC, all are sources for you. I hope you understand what is the source and what is the use. Now, source and use also, long term and short term is there. Long term source is there, short term source is there. Use also, short term use is there, long term use is there. Now, when starting itself, what I am telling is now you understand. For example, capital. Whether capital is a long term source or a short term source. Just a businessman will bring the capital and whether he will take it? No. Capital will be there till the business is there. So capital is always long-term source. Now coming to second is term loan. As I told you in the starting itself, term loan is repayable more than 1 year. So it will be there for a machinery means 5 years means 5 years term loan will be there. So term loan is always called as long-term source, not a short term. But bank OCC, for example, whether it is a short term or a long term, bank OCC is a short term. Sir, why, sir? Bank OCC also will be there for 1 year. That is the reason the Companies Act says whatever loans you are taking, if you are repaying within 12 months, it is a short term. If you are repaying more than 12 months, it is a long term. Term loan, as I told you, more than 1 year, more than 12 months, long term. Capital, till it will be there, till business is there, long term. Coming to bank OCC, every year we are renewing. Every renewal is a fresh sanction. So bank OCC is a short term. Now coming to second point, creditors. Now somebody has given credit to this businessman. How much time he wants? If more than 1 year means it's a term loan. It's a long term. If less than 1 year, if he's paying back the money to creditor, whomever he has taken on credit, it's a short term. Now you tell me, any businessman will get a credit for more than 1 year? Sir, I will give you something stock. Whether you will give me more than 1 year after that you will repay? No. Generally, any businessman will give for 15 days, 1 month, worst condition, maximum 3 months. Because he also to continue his business. He cannot give more than 1 year. That is the reason creditors are always short term. Now, I hope you understood what is a short term, what is a long term source. Capital is a long term. Till business exists, it will be there. Current term loans, more than 1 year. As I told you already, concept is there, more than 1 year. Term loan is minimum 1 year. More than 1 year, 1 year, 5 years, 10 years, like that only it will be there. So term loan also long term source. So these two are long term sources. Now coming to this bank OCC and creditors, we call as a short term because bank OCC 1 year renewal, creditors within 3 months we are going to pay. So this is the concept of under the sources also are liabilities, short term liabilities, long term liabilities, different items are there. Capital and current liabilities are long term loan are long term, current liabilities are short term. Now same point you come to fixed assets or uses. Now you should know what is a short term use and what is a long term use. Now you tell me, if anybody is creating fixed assets, this is for long term or short term? Naturally long term, because fixed assets will be there till the business exists. So always fixed assets are long term uses or long term assets, like that you should understand. Now coming to current asset, now coming to these points, raw material, short term or long term, whether it will be there for more than 1 year. If any businessman brings a raw material, whether he will keep for more than 1 year, then what business he will do? He will keep raw material for maximum 1 to 30 days or 1 to 10 days. That's all. Immediately raw material comes, he will put. If he is not using the raw material, means unit is raw, not running. It's a dead investment for him. So raw material immediately will use 1 day, 2 days. Work in progress 2 3 days. Finished goods, once the goods is ready, any businessman will keep more than 1 year, then he is not running any business. So finished goods also anybody will start within 1 month or 2 months, he will sell it. If he is unable to sell, what he will do? He will sell it on a credit, that is called book debts. Now you have sold on book debt on credit to somebody, it's called a book debt. How much time you will give to the person? See, somebody have given stock on credit. How much time you will give? 1 month, 2 months, 3 months, 4 months. You have to get it back the money. You cannot give for more than 1 year. That's why these are all are called as short-term uses. This is long-term use. This is a short-term use. Now I hope you understood what is the source, liabilities, what is the use, creating assets. Assets are nothing but uses, liabilities are nothing but sources. Even sources also we have two different words, that is long-term, short-term. Long-term is capital and term loan, because it is more than 1 year. Capital is for permanent business, is there, it exists. So remaining are short term. Here also fixed assets are long term use, current assets are short term use. Okay, so now I'll go to source and use, you are clear, and long term, short term also you are very clear now. Same thing. Now long term use is this one. Short term use is nothing but your current assets. Short term source or current liabilities are one and the same. Long term sources are capital and term, right? I hope you understand. This is the basic difference between long term source, long term unit, short term source, short term uses. Okay, now Now, last understanding. What is current liability, current assets? Because NWC means everybody says current assets minus current liability. What is current assets? Simple. Now, whatever you understand, short-term uses, this is called current assets. What are short-term sources you brought to purchase this? This is called current liabilities. In another language, in Companies Act, what they sell is whatever assets you are creating under asset side, if they are realizing into cash, raw material into cash, work in progress into cash, finished goods into cash, book debts into cash, within 12 months, if it happens, it is called as current asset. This is the technical meaning of current asset. The definition of current asset is whatever assets you are creating or bringing into the business, if it converts to cash within 12 months, it is called as current assets. Same name, short term use, both are same. Long term anyway, fixed, that's already clear. Now coming to source part. Current liabilities they call. Short term source is called as current liability. What is the current liability? Any loans you have taken, any liabilities, any sources you have taken, you are brought into the business for creating assets. If you are repaying within 12 months, understand, if you are repaying within 12 months, it is called as current assets. If it is more than 12 months, long term or a term liability we call. That's why term loan is more than 1 year. Now you see bank OCC, less than 1 year you are going to repay, correct? Otherwise renewal. So bank OC is a current liability. Same creditors also. Whatever credit you brought into the business, your businessman want to brought some stock on credit. If he, again I'm repeating, if he is bringing into the business some raw material, some stock, he is called as, the person who is giving credit is called as creditor. When your business started, when he businessman is giving credit, for him, the person who has to repay the money is called as a debtor. This basic difference never ever get confused. Okay, so these are all short term. He has to repay. Creditor will give for 1 month, 2 months only, not more than 1 year. So these two are current liabilities. Okay, so 12 months if you repay, it's a current liability. More than that, it's a term or a capital. Coming to short term, current asset also, whatever you are creating assets under assets, if it is converted to cash within 12 months, it is called as current asset. That is the basic difference between current assets and current liabilities. Now I will come. Once you understand all these concepts, then we will go to the balance sheet, how we are analyzing all these things. Let us see. Okay. The first one is, what is net working capital? You must understand what is a net working capital. Net working capital means everyone says current assets minus current liabilities is net working capital. I agree. But before going to the slide, I will tell you what exactly happened in your previous balance sheet. Net working capital, I'll tell you in this balance sheet itself. See, when it comes to balance sheet, whatever you purchase, just a minute. Huh? Hello? हेलो बोलिए जल्दी बोलिए मैं क्लास में हूँ मैडम can you call me after 1 hour please thank you okay so what I want to tell you is net working capital means please don't go by formula what I want to tell you current asset net working capital is current assets you want na? We want actually in the first slide I'll tell you show you how much we wanted in current assets. See, for example, we need 120 lakhs, correct na? For this stock. These are the current assets. We call it as a current assets. 120 lakhs. What manager told? Bring 25% margin. Then what we have done? We brought 30 lakhs. This is 30 lakh, correct na? Remaining 90 lakhs, bank and finance. This margin, whatever we are bringing to purchase these current assets is called as net working capital. I hope I am clear. Again, I'm repeating you. Whatever in the project we have shown for purchase of all these raw materials, you require 120 lakhs. For that, whatever manager told to bring margin, then we brought 25% is 30 lakhs. Remaining 90 bank and finance, I told you. This 30 lakhs is called as net working capital. I hope you understand what is the net working capital now. See, I'll show you now. This is the net working capital. These are the total current assets. You take formula, total current assets less than 12 months, whatever is there. Then you take current liabilities 120 minus 30. 120 minus 90, it will come 30 lakhs. So how bank will calculate net working capital means 120 minus 90 current assets minus current liabilities will give you net working capital. In simple terms, borrower's money brought in for purchase of current assets is called net working capital. One more example I'll tell you, you'll understand better. For example, one businessman has come. These are the current assets and current liabilities. For example, stock and all, he want, for example, some 80 lakhs he want, for example, 80 lakhs. Okay. Now you are told to bring 25% margin. How much you will bring? 20 lakhs, that capital, right? Remaining 60 lakhs, you will finance under bank OCC, right? So 20 lakhs he brought, 60 lakhs you have given loan, 80 lakhs he has purchased and he will do the business. Now, in this case, if calculation of NWC mean what he will do? Total current assets minus current liabilities if you do, this 20 lakhs only coming now. This is called NWC. But generally, for example, if it is a manufacturing unit, in capital, both current account margin and term loan margin, we have seen a 50 lakhs. In the 50 lakhs, 30 lakhs is also there. 20 lakhs fixed asset margin is also there in the first slide. So, in always in capital, both the margins will be available, fixed asset margin and current account. If you want to know what exactly this businessman brought for purchasing of these current assets, that is called NWC. Okay, now I'll show you. 120 minus 30, 90 is 30 current assets minus current liabilities. This 120 current assets minus current liabilities. Okay. Now, one more thing is net working capital. One more formula also. Assets are nothing but short-term use, right? Assets are uses. Liabilities are source. So we can, this formula we can tell, generally everybody says current assets minus current liabilities and NWC, right? But one more definition of net working capital is short-term minus short-term source. Now I'm very important slide. We are going to next slide. I never expected this question will come. Last year question, this one only. See, there is a formula without current assets, current liabilities. Also, we can take net working capital. Let us see how it is. See, this was a question last year in somebody's recall. So actually, somebody has to remove, somebody has to calculate NWC means everybody asks for current assets and current liabilities. It is not required actually. Even you take total long-term sources. Long-term source means so capital and a term loan. Total you take long-term source and you minus long-term uses or assets, you will get margin, you will get NWC. Everybody do it from bottom only. Current assets minus current liability is not required. Last time this question has come. If a person doesn't know the concept of long-term source, long-term use, he was unable to answer. Okay. So the question is like this. When a question comes for NWC, straight formula is current assessment, current liability. I agree. Other than that, one more option is there. Long-term source minus long-term use. Long-term source minus long-term use. Long-term sources are 50 plus 60, 110. And long-term liabilities are 80. How much it is coming? 30. Came na? In this you have reduced current assessment and current liabilities, na? 30 lakhs you got. But see, even from the bottom of the balance sheet also, you can call out what is the net working capital. Why it has come also I will tell you so that you may understand. See, here in the margin, as I told you in the 50 lakhs, this current account margin is also included. In the balance sheet, no businessman will show you how much margin he brought for fixed assets, how much margin he brought for current account. What he will show is, if he's bringing 50, he will not show like this. He will show only 50 lakhs. In this 50 lakhs, both fixed assets margin and current asset margin, both are included, right? That's why it is 50. Here, actually, you told 120, you remember, in your balance, in your projections. That's why he brought this 30. Only fixed assets, suppose he has to create 80, 20 is enough now. Remaining 20, if you brought remaining 60 lakhs, he will get from term loan. 60 plus 20 is 80. So 30 is extra. This is for current assets he brought. This is available on the top of the slide, top of the balance sheet. That is in capital, it is there both. So once you take entire capital plus term loans, this 30 lakhs current account, current asset margin also included. That's why it is 110. So 110, when you deduct 80, you will get this 30. One more way I will tell you so you'll understand better. For example, same balance sheet I will write like this. Fixed assets, customer want 80 lakhs. What is the capital you require? 24%? 20 lakhs only, right? Remaining term loan is you are going to give how much? For example, fixed assets, you want 80 lakhs. 80 lakhs. 20 lakhs is the margin, that is 25%. Remaining 60. Correct na? Now balance sheet is tallied na? 80, 80. Correct na? But why it is coming to 110? Because in this capital, 30 lakhs extra is available, which customer has brought for purchase of current assets. That's why the current capital with this 30 lakhs is also there. When you are totaling this, it is becoming 110. But these are the same 80. When you become 110 minus 80, when you are removing, these 30 lakhs will come out from the capital. This is one more way of calculating net working capital. Last time this question only came. When a person doesn't know about this concept, he can't answer. I hope I am clear. Actually, last time I thought that this is not required. But when the question has come, now I feel that it is required, that I should tell you. There is a one more formula for NWC, that is long-term source minus long-term use. Why it is coming? Because current asset margin also it is available there. Okay. Now you can compare same example. See, this is the balance sheet of a businessman. Current assets minus current liability. What is the current asset? 120. What is the current liability? 90. What is the ratio? What is the NWC? 30 lakhs. This is a direct formula everybody knows. One more way, what I told you, total long-term source you take and you deduct long-term use. That means 50 plus 60 is 110. This is 110 and this is 80. 110 minus 80 also again 30. This is how you can calculate. This one is this formula. This is a current assets minus current liability formula. So both the formulas you can use whenever examiner wants to check your knowledge in balance sheet. Directly they will not give you current assets, current liabilities. They will only give the top area, this area, and they will ask you to calculate. Then if you have an idea, you can easily answer. Now, NWC is over. So NWC, what is NWC? NWC, again, I'm telling you, whatever margin he brought for purchase of these current assets. 120 lakhs you want to purchase of current assets. How much margin you bought? 25%? 30 lakhs. This is included in 50 lakhs. Again and again, I'm repeating. This is called NWC. 30 lakhs. What you brought for purchase asset is 30. Because you brought 30 out of 120, remaining 90 bank has given finance. 90 plus 30 is equal to 120. So that's the reason the formula works like this. Current assets minus current liabilities means naturally you will get what was available on the capital for your purchase of current assets. Okay. Now I'll come to current ratio. What is current ratio? Everybody says current assets. For examination part, it is n of current assets minus divided by current liabilities. Current assets to current liabilities, if you calculate, it will come current ratio. Okay. But what is a current ratio? You must understand first. Why any bank wants to know what is the current ratio, I'll tell you first. You have given a OCC, for example. Try to understand. You have given a OCC of 10 lakhs. Party has purchased stock, he kept in the godown. Maybe some book debts also available. He has given on credit. So what, when you are giving money for purchase of stock in a worst condition, what any bank wants, what any bank thinks is, if I sell those stocks, whatever I have given loan, whether I will get the money or not. I have given 10 rupees. Whether stock is 10 rupees means 1:1 basis, I am comfortable. Minimum margin is not there, but whatever money I gave, that stock is available. So current ratio means at a worst condition, okay, if at all the business has gone to liquidation or business he wants to close, whether that assets, whatever you have financed, whether they are clearing your liabilities or not, any banker wants to know. To know that only, every banker will calculate current ratio. When we will date, sir? Generally, if you are now we are taking a balance sheet in the month of September. Generally, we take on 31st March balance sheet and see how much you have given loan, how much assets are created. Whether minimum, if you sell that assets, whether your liabilities will be cleared or not, you must know. Okay, that is the reason current ratio works. So how much current asset a firm is having to clear current liabilities at any eventuality. See, you have given money and he has purchased this. At any eventuality, if this is sold, whether your liability will clear or not. This is comparison is nothing but current ratio. Okay, I hope you understood what is a current ratio. Now we will calculate current ratio in this particular balance sheet. Okay, now what you have financed here? 80 lakhs. Your loan is 80. Creditors are 90. How much stock he has purchased? 120. Correct now? Now what banker will check is, if I 31st March balance sheet, for example, what is current assets? 120. If I sell 120 rupees this stock, I will get 120 rupees. Whether it will clear your liability or not. Definitely. 120, 80, 80 will be aram se they will clear. So comparing this is called as current ratio. Okay. 120 means okay. For example, OCC is 80. For example, your current assets are even 80. Yes, no problem. It will be cleared because 80 to 80 is okay. But of course, he is having a creditors also. If 80 are, even if you sell, if creditors are cleared, only 70 lakhs will be available for your loan clearance. So every time in a periodical manner, generally we do on 31st March only, we compare how much assets he is having in current assets, whether if I sell, whether my liability will be cleared or not, we have to check. For example, current ratio is come as 1. What does it mean? It current assets also 90, current liabilities also 90, for example. This proposition you see. This is also 90, this is also 90. So 90 by 90 is 1. That means equivalent, barabar, no problem. Even if I sold 90, my liability will be clear. Okay. For example, now 120 is there. 120 assets means liability is 90. 30 lakhs extra available in stock. So your bank is in better position. So the current ratio will be around 1.33. 0.33% is extra available in stock. This is how current ratio will be seen. Current ratio 1 means equal stock and liability. Okay, barabar. My loan and party stock both are available, but something is missing. What is missing? Margin is missing. He has not kept any margin. With your money only he is doing business. This is called current ratio is 1. Both are same. Okay. Now coming to this particular ratio, you can see now in this balance sheet. Current ratio is the ratio of general formula I told you now. Current assets by current liabilities. Now you see what is the current assets? Raw material, work in progress, finished goods, book debts. All are 20 plus 20 plus 40. So total is become 120. Okay. So now I'll go to current liabilities. What are the current liabilities? Actually 90 lakhs. See 90 lakhs is. So formula says 120 by 90. Current assets minus current liabilities. 120 by 90. 4 by 3. 120 by 90 is nothing but 4 by 3. How much ratio they got? 1.33. What does it mean by 1.33? If you understood, then you understood the balance sheet. 1.33 means 120 is nothing but 1.33 and 90 is only 1 rupee. He can clear 1 rupee and 0.33% extra available in stock. That means your bank is safe. I hope you understand. That is the reason we calculate current ratio. Why we would do it? Whether there is 120 stock, if I sell, whether my 90 will be cleared or not, bank will check periodically on 31st March every year before renewing the limits. This is what current ratio. Okay. Now one more ratio very important is TOL by TNW. Total outside liabilities by tangible net worth. Now you will see how to arrive tangible total outside liabilities to tangible. Ratio of total loans. That means whatever loans a borrower, how many loans you have got now? Capital you brought, term loan you have taken, OCC you have taken. Somebody is giving a credit, creditors will be there. Same. OCC, term loan, creditor. Generally, these are the sources, loans, liabilities. Okay. Now another is tangible net worth. That is capital. Generally, capital. I will tell you intangible assets at a later. Okay. Example, if party brings 25% margin into the business, as you in the balance sheet you brought it, now remaining 75% bank will finance. That means bank loan is 75%, margin is 25%. Now the balance sheet what we have analyzed is same. 25% manager asking you to bring. That means 75 is given. A 200 lakhs is the project for you. How much margin you brought? 50 lakhs. How much money bank will finance? 150. Same, na? This is this one and this is this one, right? If you make, for example, 150 by 50, what will come? 3 is to 1. One percentage of loan if borrower brings one share, 3 shares bank has given. That is 75, 25. Okay. So for example, now margin is 3 is to 1. This is 3 is to 1 concept. That means 25% margin is there. The project what we have given to the bank is 25% margin. So it will come 3 is to 1. Very good proposition. 3 is to 1 is. Now we will go to example number 2. For example, bank says margin is 20%. In some loans, bank says margin is 20%. Then borrower will bring 80% and margin borrower will bring 20%. Bank will give 80%. Then what is the current ratio? 4 is to 1. One if one time if customer is bringing, 4 times loan is giving, that is called 80 is to 20. As I told you, in Mudra loan, only 15% we have to bring customer. Then how much loan bank will give? 85%. Okay, this is how TOL, TNW will be calculated. How much margin party is bringing, how much funds we are getting. Now you tell me, for a bank, which one is better? Margin should be more or margin should be less? For a banker point of view. Banker point of view, always margin should be more. Because if margin he brings 50%, you are giving 50%. If anything happens, you are safe. Minimum that stock, whatever you sell, if you get 50 rupees, your liabilities will be cleared. Always bank likes to have more margin. Customers always want less margin because they don't want to bring more capital into the business. But generally, as I told you, 25% margin is required. When bank makes 20%, for example, if you see bank MSME schemes, tailor-made schemes, okay, they will say only 20% margin is enough, because in those loans generally bank will put some collateral security norms. If you give 100% collateral, 75% collateral, then bank says, okay, customer, you bring 20%, 80% we finance. Normal MSME loans, 25% customer will bring, 75% bank will finance. In schemes, 20-80 ratio will come. But in Mudra, like government schemes are there. Their government says banks, you take only 15% margin. That means banks exposure will be 85%, where the ratio will be more. Okay. Now calculating TOL by TNW, we will see. This is the TOL TNW. As I told you, total outside liabilities to tangible net worth. Total outside liabilities means all these liabilities are total outside liabilities except capital. How much loans he has raised for running the business are TOL, total outside liabilities. One more is tangible net worth. What is tangible net worth? Generally, for a small proprietorship partnership accounts, capital is a tangible net worth, no doubt. But when it comes to companies, in the asset side, intangible assets will be there, like goodwill, patents. Okay, they are all called intangible assets. It's an asset only. For a company, it's an asset, but actually it's not an asset. That's why it is called as intangible. We cannot touch that. Only in the books they will say by brand name, like Tata, Reliance, by brand name, they have that. That is called intangible asset. Okay. So those intangible assets, while calculating tangible net worth, total capital they will take. Capital, reserves, everything they will take. But they will deduct these intangible assets. Then they will get tangible net worth. Okay, so capital, that is capital minus any intangible assets. And remember, intangible assets will be for companies and all. Proprietorship and partnership, we will never find intangible assets, right? So this is tangible. Otherwise, simple capital you take, that is tangible net worth. If any company balance sheet you are analyzing, intangible assets will be there. Deduct those, then you will come to tangible net worth. Net worth means capital. Tangible means minus intangible assets is a tangible net worth. Right? I hope you understood. So now let's calculate total outside liabilities to tangible net worth. Now these are the liabilities. 60 lakhs term loan and 90 lakhs is the your liabilities in this, correct now? 150. This is total outside liabilities. In the liabilities, term loan, bank OCC, creditors, all loans this customer has taken. So all will be added, 60 plus 90, 150. What is the net worth? As I told you, in this balance sheet, there is no intangible assets. So capital is the net worth. So current only 50 lakhs capital is the net worth. So 150, tangible 50. Therefore, this 50 will come here. So this 150, 50. So 150 divided by 50 is the formula. 3 is to 1. What does it mean? Again, I'm repeating you. You brought 50 lakhs. Okay, capital. How much loans you can raise? 3 times. 50 का 3 times कितना है? 150. This is the 150. 90 plus 60. So 50 lakhs he brought in capital and loans he has raised 150 lakhs. This is okay because one and this is 3 times. One time customer has brought, 3 times he borrowed from the bank. This should be the ratio if you are taking 25%, 25%, 75%. 25% capital you brought, 75% loans you can raise. It cannot be less than that if margin is 25%. Now, this is coming to liabilities and assets. Just in our working capital manual, they have given. There are in liabilities, capital will be there, term liabilities will be there, current liabilities will be there. When it comes to asset side, fixed assets will be there, non-current assets and current assets and intangible assets. As I told you, for companies, you will find one more column called intangible assets. See, goodwill, patents, okay, accumulated losses. This is very important terminology. Try to remember. That's why I put it bold. Preliminary and pre-operative expenses. See, one business, what is this preliminary pre-operative expenses means? For example, one businessman wants to start a business. Before business starts, he will do some expenditure for license, for R&D, all these things. These are all called as preliminary and pre-operative expenses. These expenses he will show under intangible only. And goodwill, patent, any company brand name means they will show them. Okay, these are all called as intangible assets. Please try to understand. Preliminary expenses and pre-operative expenses are always coming under intangible assets. Okay, but one more name you will forget, you will confuse is prepaid expenses. Prepaid means you have paid to somebody, it will come back to you. It's a current assets. Preliminary, pre-operative, the name itself is preliminary, pre-operative. Business not started. Before that, I've expended something for starting that business. For example, for license, for DAC, licenses, approvals, I will spend some money on R&D. These are all called as preliminary before starting. Pre-operative, business is start now, pre-operations. All these are all intangible. But the prepaid is only paid. So it's an asset. Okay, prepaid. 1 month telephone bill you have paid earlier. It's a prepaid expense. Okay, that is an asset. Okay, I hope you understood what is intangible, because sometimes you have to calculate tangible net worth. In that they will tell capital is this much. They will say preliminary operative expenses. Then you have to deduct. Why? Because it's an intangible asset to know the tangible net worth. Of course, this capital always we have seen that whatever money margin he brought, it's a capital. Every year profit, whatever in the business, if you pluff back in the business, that means last year I got 20 lakhs profit. I have withdrawn 5 lakhs. Remaining 15 lakhs, I carry forward and kept in the business. So the reserves will be added to capital. My capital will increase. So reserves and my own income. So I want to continue. I want to keep in the business only. So capital plus reserves is nothing but net worth. This is customer's money. Capital, what he brought in the business. Reserves, by virtue of business every year, he will earn profit. Out of that profit, if anything he kept in the business, it is called as reserves and surplus. Okay. Now come to term liabilities. As I told you, term loans, deposit, any borrowing payable more than 1 year, even debentures not maturing within 1 year. Okay. These are all called as term liabilities. And coming to current liabilities, bank OCC, unsecured loans, creditors, advance payment or provisions, all are falling under current liabilities. Okay. This is, please remember, beyond 1 year. Anything 1 year above, whatever loans you are, whatever house you are using, it is a term. Okay. Fixed assets, land and building, plant and machinery, vehicles, companies. Non-current, current assets you see first. First fixed assets is over. And current assets are inventory, debtors, cash and bank, investment in fixed deposit, advance to raw materials, prepaid expenses, advance taxes paid. Okay. All these are coming under current assets. But mostly current assets we see stock, book debts, cash and bank balance. These three are very, very important to remember. Now coming to non-current assets. See, whatever money you brought into the business with capital and loans, if you purchase a fixed asset or invest in fixed, it's a fixed asset. If you are purchasing stock and all, it's a current asset. But if you are doing some other thing other than business, it is coming under non-current assets. Now you see what is that? Investment in subsidiary companies. And I have given loan to you and you are investing in subsidiary companies. So it is not actual original business. You are not borrowed for, you borrowed money for your business, but you are investing in your subsidiaries. It is a non. Okay. Then deferred receivables, loans, advance, deferred nature of such holdings, unquoted investments, non-consumable stores and spares. These are all called as non-current assets. Or for example, even you purchase something, some land or something which is not related to business, that also they will show under non-current assets. These are the liabilities and assets. So assets are nothing but uses. Liabilities are nothing but sources. Capital and term are long-term sources. These are short-term sources. Coming to uses, fixed asset is a long-term use. Current asset is a short-term use. So with understanding this, now you can answer any question comes under balance sheet. Okay. This is what you should understand, the concept of balance sheet. I hope If you are with me for the last 1 hour, hope you understood what is the balance sheet. I took 1 hour. I will see whether problems also we will try for 5-10 minutes, whatever time possible. We will resolve some answers so that you will be confident in the exam. If at all any question comes from problem side, okay. 1 minute. I'll open the slide. Now understanding this concept, whether you could able to answer or not, let us see. This is a recalled question of Union Bank of India. You see, current assets are 50 lakhs, NWC is 10 lakhs, calculate current ratio. What he is telling, first try to understand. First of all, always write like this. Liabilities, left hand side, sorry. Always left hand side liabilities. See, I got confused. Assets are like this. Then you should know here capital will come, here current liability will come, here fixed assets will come, here your current assets will come, right? This is the balance sheet. Non-current assets will be there, okay? Both should tally. This is the basic concept of balance sheet. What is telling? Current liability is 50 lakhs, right? 50 lakhs. Okay. NWC is 10 lakhs. What is NWC, sir? From here it is coming, na? Okay. So if it is 10 lakhs margin for purchase of current assets, how much current assets? Naturally 60 lakhs. Without seeing, if you understand the balance sheet also, you can answer. You need not go for formula. What is telling? Current liability is 10 lakhs. NWC is 10 lakhs. NWC is nothing but 10 lakhs. Whatever you brought for purchase of current asset. These two only will create, na? So 60 is the answer. Simple. Understanding the concept will give you this. And another way of answering. This is how actually it can be answered very easily. And now what is how the calculation will be done? Answer is one current liability is 50 lakhs. This I have taken. NWC is 10 lakhs. Okay. What is the formula? Current assets. One more way. Current liabilities is equal to NWC as I told you. Or one more formula what I told you. Long-term source minus long-term use also current ratio, NWC. Okay. Okay. Now let us see current asset. What he has given? Current liability 50 lakhs. Okay. What he has given? NWC 10 lakhs. Now how much if you deduct 10 lakhs will come? One more way. 60. 60 minus 50 only can become 10. Na? So this is one more way. This is a formula wise way. This is a concept wise answer. This is the concept, what I told you. This is a formula wise. Okay. I hope you are clear. Okay. Just now I told you current is NWC. Long-term source minus long-term use also. You can get the okay. Current ratio means current assets minus current liabilities. And quick ratio is also there. One more formula. That current ratio, quick ratio, one and the same. But only difference is quick assets minus current liabilities. Quick ratio. I will tell you. For example, there are liabilities, assets, current liabilities. For example, current liabilities, bank OCC is there. Some 30 lakhs. Creditors are there, some 20 lakhs, 50 lakhs, for example. Now coming to current assets. With this, you'll create current asset stock. Okay. Book debts, cash. 50 kada. 50 plus 30, 80, somewhere 20, 30, 20 like that I'll put. Okay. These are the loans. This is the assets created. Remaining will come under margin. This is the net NWC. Okay. So 30, 30, sorry, 30, 20, 70. This is 70 minus 50. So my NWC is 20 lakhs. This much I should bring in the margin for purchase of this asset. Okay. Now what is telling is quick assets. See, comparing current assets to current liability is current ratio. You have given loan to purchase of assets, compare it. One more ratio, what they will do is quick ratio. Quick ratio means if anything, this is the normal condition, worst condition, where suddenly business collapses. So what you can sell very fast is called quick assets. So what they are telling is already sold, book debt is created means already sold, money is to be received. This is a quick asset. Cash is already available in your hand, quick asset. But stock is not a quick asset. So you have to take only these two, book debts and cash. That is 50 lakhs. That is quick assets. Liability is same, no difference. 50 will come here. 1. So quick ratio is 1. For example, same business, if you take current ratio, you take everything 30, 70 will come here. current assets, and it is 50. It is coming to 1.23 something. You see, it is coming 1. Why? Because you have removed stock. Why you have removed stock? Because here we are calculating quick ratio. Quick ratio means what? Leave the inventory. In the current assets, leave the inventory. Remaining items compare with current liabilities. Because if any eventuality comes, I cannot sell the stock immediately. Cash, yes, I can take. In book debt, okay, already sold. Money is only had to be received. I need not sell to anybody's stock. So book debts, cash, everything they will take. But stock, they without stock, they will compare current assets to current liability. Remove stock from current assets, compare. That is called quick ratio. Simple. Now one more is TOL by TNW. Already we discussed. One more is debt equity ratio. Long-term debt to tangible net worth. You know what is the tangible net worth? Capital is net worth. Okay, if you want a tangible net worth means total capital reserves, from that you have to deduct intangible assets, then you will get tangible. Long term debt means term loans. Already you know the long term. Long term means capital and term loans. Capital is not a loan. So it is a loan for the business, but for a businessman, it's not a loan. Okay. So only term loans you will take and you will compare with capital. It is called as debt equity ratio. One more for term loans. These are all, these two we see for working capital, stock related, but these two are we see for term loans. So DSCR, debt service coverage ratio, one more formula is there. This is for term loans we see. So formula you have to remember. Now it is not the right time to discuss on DSCR. NPAT, net profit after tax plus depreciation plus interest on term loan divided by again interest on term loan into installment. This is the formula. NPAT plus depreciation plus interest on term loan divided by interest on term loan plus annual installment. Now let us see some questions. Easy question. Current assets 20 lakhs, current liabilities 10 lakhs. What is the NWC? Simple. NWC means current assets minus current liability, 10 lakhs. Current ratio means comparing current assets to current liabilities. So current assets are 20, current ratio, current liabilities are 20. So 2 is the answer. MWC is 10 lakhs, current ratio is 2 lakhs. Right? Now one more. Just now we have answered this now. Current assets 20, NWC is 5 lakhs. He will ask what is the current liability. Put in the formula. Easy question. We know current assets minus current liability is NWC. He has given 5 lakhs. He has given 20 lakhs. What amount if you deduct, you will get 5? That is answer. So 15 is the answer. 20 minus 50 is equal to 5. Mathematical. Understand the formula, remaining all mathematical. Okay. Now, this is a typical little bit of problem. You must know, draw the balance sheet. What is the current asset? What is the current liability? You should know. Now, we will see stock, for example. You calculate on your own. Stock is a current asset or a current liability. Stock is an asset. It's a asset because you are creating that asset. It's a use of money. So stock 20 word. Creditors, where it comes? Creditor means a person who is giving raw material on credit to your customer. So it is a source. How much, sir? 10 lakhs. Now debtor. Debtor means what? Debtor means businessman is giving credit to somebody for 1 or 2 months. So it's an asset for him. Debtors will come here. Bank OCC. Bank OCC is a liability to the customer. So OCC also will come as a current liability. Why it's a current liability? Less than 1 year he has to pay 10 lakhs. Now last one is provisions. Provisions are always coming under current liability, 2 lakhs. So this is 22 lakhs current liability. Current assets are 25. If you want current ratio, 25 by 22. If you want NWC, 25 minus 22. What is the question as asked? Calculate NWC. 25 minus 22. Answer is 3 lakhs. Over. Right? This is how you have to answer this question. First of all, you have to draw a line. This is called, in this problem, you should know what is the current asset, what is the current liability. In earlier problems, they themselves are giving what is the current asset, what is the current liability. Direct and get the answer. Same question. Current assets are 50, NWC is 15,000. Same formula. current assets minus current liability is equal to NWC. NWC is 15,000. Easy question only they will ask. Current assets is 50,000. How much you should deduct? 35,000. This is the answer. Simple. 35,000. Okay. This is twice. Debt equity actually I have not told you, but let us try this. Debt equity is nothing but I will tell you. For example, capital is there, term loan is there, OCC is there, fixed assets are there, current assets are there. This is called current liability, right? See, comparing all the loans, okay, with the capital is TOL by TNW. This is TOL by TNW. Total outside liabilities to net worth is called TOL by TNW. Same thing, only term loans are compared with capital. This is debt equity. This is long-term debt to capital, tangible net worth. Only long-term loans to net worth, if you see, this is called debt equity. Total loans, if you see, it is TOL by TNW. That is the basic difference between TOL by TNW and debt equity ratio. In term loans, we calculate debt equity because long-term loans for which purpose we will give? For purchase of fixed assets. So that's a term liability. Now you see, this is a different question. Total assets he has given. That means you must know that balance sheet is tallied. Let us see. First of all, we will take the total assets. So balance sheet is both sides 20. That is what he is telling. Now he is telling current liabilities. Liabilities left hand side, assets side. What is the current liabilities are? 10 lakhs. Capital is 4 lakhs. How much is the debt equity ratio? Now you got capital, you got capital, you got OCC. Now in between what is there? Term liabilities. How much it will be, sir? 10 plus 4 is 6, 14. If you make it 20, how much it will become? 6 lakhs naturally. So you must know this answer is 6. When you if you understand what is the balance sheet only, you can draw this, you can answer this type of questions. So again, I'm repeating, he has given capital 6 lakhs from the question. Where is the capital? Capital is 4 lakhs. Capital is 4 lakhs. Current liabilities are 10 lakhs. Total asset is 20. That means in between current capital and current liability, there are term liabilities. So by this totaling 20, 10 plus 4, 14 means this is 6 is the answer. Now what he wants? Debt equity ratio. What is the long-term debt? Long-term debt is 6. What is the tangible net worth? 4. Capital. So 4 by 6, it will come to 1.25 something, 1.5. See, 1.5 is the answer. Okay, I hope you understood. Again, I'm repeating this little bit. You should understand. First of all, he has given 20. I have written both sides 20, 20. Assets and liabilities. Then liabilities, then assets. Then current liabilities 10 lakhs. Again, I'm answering this question. So capital, he told 4 lakhs. This one is capital, 4 lakhs. This one is 10 lakhs. Now, in between, the balance should be filled here. That is 10. So total is 20 means 10 plus 4 is 14, right? So what is the balance is 6 lakhs. Formula is for debt equity is long-term debt by net worth, tangible net worth. What is the long-term debt? 6 lakhs. What is the tangible net worth? 4 lakhs. 6 by 4 is 1.5. This is how you have to calculate debt equity ratio. Just I'm skipping these questions, you can practice. Yeah. Now DSR calculation. With this, I'll finish the class another 5 minutes. So as I told you that formula you have to remember for DSCR. The formula says like this: net profit after tax plus depreciation plus interest on term loan divided by again interest on term loan plus annual installment or installment. Okay. Now let us see what is an NPAT 150. What is depreciation? 60. What is the interest on term loan? 40. Again 40 will come here because interest on term loan plus installment is 80. So total is 150 plus 60, it is 250 divided by 125. So answer is 2. Simple formula. Okay. Now second problem. Only three problems. So here net profit before tax he has given. Formula is net profit after tax plus depreciation plus interest. Again, I'm telling interest on term loan plus installment, right? Net profit after tax. No. In the table, he has not given net profit after tax. He has given net profit before tax and tax. Before tax is 200. So if you deduct the tax, what will happen? And PAT will come. So 200 minus 50 is net profit after tax. So 200 before tax is 200 minus 50. So it will become 150. So 150, same formula again. Depreciation 100, interest on term loan 50. So it is 300 divided by again 50 interest on term loan plus annual installment is 120. So 170. 300 by 170, whatever ratio cut, that is the answer. 300 by 170. 1.76. Okay, last problem. Same net profit after tax, everything is given. As I told you, the formula is net profit after tax plus depreciation plus interest on term loan divided by interest on term loan plus annual installment. Now you see NPAT already has given 200. Now tax also he has given. Whether you have to deduct? No. If it is net profit before tax, then you have to deduct tax. This is for confusion purpose he has given, ignore. Already you got NPAT, na? Direct 200 you take. If he says before tax means you have to deduct tax. After tax means for confusing only has given, ignore. So 200, depreciation 100, interest 50. Become 350 divided by 50 plus 120. 50 is term loan, again interest, and 120, 170. 350 by 170 is the answer, 2.06. So DSCR direct problem will come. Sometimes he will give before tax and tax, you have to deduct. Sometimes to confuse you, he will give after tax also, tax also. Then ignore the tax. So understand the problem properly and calculate DSCR. Always DSCR benchmark is 1.5. What is 1.5 is, if you are giving a loan for a car, any term loan you give, we calculate DSCR, car, bus, okay, or any manufacturer term loans you have given for plant and machinery, we will calculate DSCR. DSCR 1.5 means, you must understand what is DSCR means. 1 rupee 1.5 means, if the installment is 1 rupee, DSCR 1.5 means he is earning 1 rupee 50 paisa. Your installment is 1 rupee means, if customer is earning 1 rupee 50 paisa means it is a good ratio. 1 rupee he will repay, 50 paisa he will take to house. That is called 1.5. So that's the reason we have decided, Companies Act have decided, benchmark always for current TSCR is 1.5. Minimum 0.5 buffer should be available in the business, income to the businessman, so that he will repay 1 rupee due and 50 paisa he can take to his house. Okay. In some cases, we permit up to 1.25, but generally the DSCR is 1.5. Because in interviews also, they may ask you what is DSCR, why you calculate DSCR, what is the formula of DSCR, where you calculate DSCR. These concepts, if you know, you can answer any type of question. Okay. So with this, I think this is some more questions I have kept here. I'll give the presentation. You can practice those questions. So with this, I'll stop here because I have a class again at 7 o'clock. So I'll close here. Any doubts are there, I'll see. Otherwise, I will end the session. This presentation, I'll share it with you all. Sir, you can stop recording, sir.
Okay, sir.